If there's one thing we all want to know, it's how safe is my money? And this is not about investment performance or inflation or any of that stuff, but it's about protection in case a financial provider fails. And as our wealth grows, this becomes a bigger factor for us. Now, fortunately, here in the UK, we have significant protection against provider failure, and I want to explain how it all works in today's video. Hi and welcome back to the channel. My name is Pete Matthew. I'm a chartered financial planner based here in the UK, and I've been putting up videos on YouTube for more than 10 years, giving you everything you need to know and everything you need to do to secure your financial future. That's a long sentence to get out in one go. In my day job as a financial planner, I get to help people with large sums of money every day, and inevitably, as those numbers get larger, the question about not having all your eggs in one basket comes up. So I want to look at the answers that I give to my clients when they're concerned about financial protection, and hopefully you'll be able to apply them to your situation and take some comfort from them too. Now, here in the UK, we have a government-backed safety net called the Financial Services Compensation Scheme, or the FSCS. And I'll put a link to their site in the description. It's important to know what the FSCS does not cover. It won't pay out if you lose money because markets go down, for example. It won't cover you if you are scammed. As it says on the front page of their website, the FSCS is there to protect you when financial firms fail. So this is about you trusting a company with your money, and then they fail for whatever reason, and the FSCS picks up the pieces and returns your money to you. So this applies to banks and building societies, pension and investment companies, credit unions, mortgage companies and other lenders, even debt management companies. If you have money looked after by someone else, and if they can't honor their responsibility towards you, the FSCS is there. And the scheme is funded by levies on the financial services industry. I'm standing in the offices of Jackson's Wealth Management here, my independent advice firm, and we pay a levy to the FSCS, and so do all the regulated providers in the country. Now, as an individual, you can make a claim directly to the FSCS with no fees to pay, and you keep 100% of the compensation. But there are limits as to the amount that will pay out, and the limits differ between different so-called classes. For those of us who are building wealth, these are the important ones. Money held in a bank or building society is protected up to £85,000 per person per institution, or twice that, £170,000 for joint accounts. There's also a temporary high balance protection for if you receive a chunk of money from a life event, like an inheritance or a property sale, redundancy or a divorce settlement. You need to check because some banks have different sub-brands, and you could find out that you're banking with the same bank just in 2 or 3 different guises. So that's money held in a bank or building society. What about money held in investments? Well, the FSCS limit there is £85,000 per person per institution again. For pensions, 100% of the value of your pension is protected with no upper limit if your pension provider fails, but it's only an £85,000 limit if it's a SIP provider. More on that little wrinkle in just a second. Okay, we need to dig a little bit deeper now, but before we do that, if you haven't already, make sure you hit the like button and subscribe to the channel. Most people don't, but it really helps, so thank you. Only 20 years or so ago, the organization of our finances was much simpler than it is now. We had a pension with an insurance company, we had investments with fund managers, and we had cash in the bank or building society. We knew where our money was, but these days it's much more complex. So you might have a self-invested personal pension, or SIP, with one company. Inside that SIP, you might have a platform, or maybe 2 or more. On that platform, you might have funds with 6 different fund houses. So where exactly is your money held? If one link in the chain goes bust, who is on the hook for getting your money back? Well, let's work from the bottom up. For individual investment houses like Jupiter, Invesco, Fidelity and the like, the £85,000 limit applies. So if you have more than that figure with any one investment company and it fails, you're potentially at the risk of losing any money you have in excess of the £85,000. And really, this is the level that matters most in my view. If you really want to stay close to the FSCS limits, keep less than £85,000 with any one investment provider. Now let's move up a level. And we're at the account stage. So maybe you invest with a platform like Hargreaves Lansdown, and you've got an ISA or a pension or a GIA. Money in an account with any platform is held on trust for you and is looked after by a custodian. Sometimes platform acts as its own custodian, certainly the bigger ones do, and that's fine, definitely makes things simple. The idea is that your money is kept separate from the platform's money. So they can't dip into your pension to pay their staff, keep the lights on, or buy the CEO a yacht. If you dig into the T's and C's of the platform you're using, you should be able to see who the custodian is. Now, strictly speaking, the custodian would be deemed as one provider for FSCS purposes. But if you think about it, they're really only holding any cash that you have in your accounts, because the rest of the money is invested in funds. It's a level down. The custodian keeps records of the units or shares that you hold in the funds, but that's an admin function. The money is actually held with the fund providers. So if you have £500,000, say, invested in an ISA with Hargreaves Lansdown, and you spread that across 6 different fund providers inside your ISA, well, that's less than 85,000 in each, and so you're fine. Now, if a platform was to fail, your cash might be at risk if you had more than 85 grand sitting in cash, which you shouldn't. But the underlying funds should be okay. Now, practically, there would likely be a delay while somebody sorted out who owned what and reconciled the books and did all that. But platforms really are just admin systems and cash holders. If they did fail, someone else would probably likely swoop in, hoover up the assets, and you'd end up exactly where you were, probably just with a different brand name on your quarterly statement. Some people add an extra layer of complexity on top of all this and wrap their platform investments inside a full SIP, say. So you might have a SIP with a proper SIP trustee and hold maybe a commercial property inside it. Then you also might have a platform with a GIA inside your SIP, and inside that GIA, on the platform, inside your SIP, you might hold 6 funds. Confusing, isn't it? But ultimately, it's much the same thing. The money is largely with the underlying investments right at the bottom of the chain. The rest is just admin and some cash management. Now, finally, if your pension is with an insurance company like, I don't know, Aviva, Scottish Widows, Legal & General, Royal London, it's actually a lot simpler. You get 100% of the value of your pension protected if the provider fails, with no upper limit. But be careful, because this applies to their insured pension products like stakeholder pensions and annuities. But many of these providers also have their own platforms too, and they act much like the independent platforms that we were just talking about. So tread carefully. So there's a lot to think about here, but it's important to remember that here in the UK, we have some of the strictest client money and assets rules in the world. These are sometimes called the CAS rules, and they lay out the responsibilities of providers to look after your money, to account for it and reconcile daily, to ring-fence your money from theirs, and to do the right thing at all times. The level of regulatory oversight of financial services in the UK is intense, and I should know because I'm a regulated individual myself. I just can't imagine the hoops that somebody like Lloyds Bank or Hargreaves Lansdown have to jump through. Bigger companies have their own regulator, the Prudential Regulatory Authority, or PRA. Everybody else is regulated by the FCA, the Financial Conduct Authority. Now, obviously, no regulation regime is perfect. The British Steel Pension Scheme disaster is a case in point. But generally speaking, the regulators here in the UK do a decent job of making sure that people are looked after. So let's be practical here. It's fairly easy for most of us to stay the right side of that £85,000 limit, particularly if we're in a couple and we trust our partner. If you get into the high 6 and 7 figure realms, then you either need to just accept a ton of complexity and spread your money across loads of different accounts and providers to keep less than 85,000 with any one, or you need to relax a little bit and rely on the extraordinarily tight regulation here in the UK. But definitely check your own situation. Dig into the providers that you're using and ask them what the deal is. They will all have a customer-facing document which explains the risks and the protections. I'll put a link in the description to a really good example of this from the UK's biggest platform, Hargreaves Lansdown. That is not a recommendation to use them, it's just an example. Okay, well, I hope it was helpful, folks. Any questions or comments, please leave them below. I'll do my best to answer them. Hit the like button and subscribe if you haven't already, and I'll see you in the next video.